Good afternoon. What we're going to do today is explore using hedging and parlaying, the indicators, just about everything that is a New Era Trader to show you how to make money intraday, overnight, using options. We try, in other words, right now we are looking, I put out a major piece suggesting we're going to have a substantial rally. Given what I teach, the market has been trading at the giant 40 buy on the daily chart for months now. It penetrated it briefly, took it out, and came right back in, and now we're looking at the backside of a rally. And if you notice, I'm talking about the market is rallying. There's much larger resistance between 1175, 95, see on the daily chart. I'm putting out alerts to start buying puts. Now, the reason I like puts is the fixed charge, and we're using the SPY, the SPIDA weeklies, the weekly expiration. So you see long the 115s at 85 cents. That's what we're starting to buy them at 85 cents. So there's much larger resistance. Right now the market is opening somewhere around 1140. We're looking at major resistance between 75 and 95 on the daily chart. Now the reason I like to buy puts is the fixed risk. As we get into these resistance areas, I like the fixed risk, 85 cents, 60 cents, and I have the open-ended side of the S&Ps going higher, open-ended with a fixed risk. And then we're going to hedge every time. Now, what this does, being long options and using the S&Ps as hedging, it forces you to trade. You may not feel like trading, but when you get into these trend-type moves or trading range moves, it forces you to do trades where you really should be doing them because they're natural places to be long. And if you're long puts, you don't mind getting long because if it goes a little lower, you can buy some more. Okay, so what we're talking about basically here is, and I want to do something across here. There's a little breakout here I see. I'm going to mark things as I see them on the chart. Right now we open up, the ADs are 1 to 2. The market is coming down from a previous high, retesting the high of the previous day. We're now about a 40% of the retracement from today's high to yesterday's low. Early support, say 1129.31. We're oversold. Okay, the market rallies. All right. Early resistance at 1141, 1145, 48. This will become support later on. And then the market starts rallying. Okay, so now we're starting to get up into an area. Got a little divergence. See, market's jammed. Okay, we got a little divergence. So now we're starting to buy puts. Okay, I put out the email. We're looking to do puts under $1. All right, so the market, now the AD's at 3 to 1. The market's very strong. So we're more than happy to be long cheap puts. Okay, and we're now looking to start hedging. Now, when we get into these kind of trend moves, sign of strength, see the oscillator's trading between jammed and 44. The market is now working its way higher. So we're looking to buy all along these lines. So the market goes up, we get long hedging here. We get up to a normal sell point, making marginal highs, 80% of the high of 929. We come down to the mid-uni, 44. Oscillator's telling us, sign of strength. We hedge again. Now, what I try to do with the SPY options, the SPIDA options, is hedge about every 14, 15 cents. So I buy in multiples, I double. Let's say I'll make it easy for you. I start buying 5. The next tranche is 10. The next tranche is 20. The next tranche is 40. And the next tranche is 80. Very rarely do we get beyond 4. 4 hedges, 4 parlays. Okay, now you can see each one of these. Look at these moves here. This is 10 points. This is $500 for E-mini. This is really a nice move. We like to do the E-minis against the SPY in ratios of 20% out of the money. So if you're long 10 SPYs, we buy 2 E-minis. If you're out of the money, if you're at the money, we can do as many as 3 and 4. So it gives you an idea of what you can start making. So now we hedge in again. This is about 16 cents. Hedge here, goes a little lower, just add some hedges. Now, what's important, the employment number is coming out tomorrow. This is when I'm showing you how to play news. Now, Goldman, earlier in the week, came out, and when the market was crashing on Monday, making new lows on Monday, Goldman Sachs came out and lowered their job number. They were, I think, at the street was somewhere between 50 and 70. Goldman lowered it down to 40. So the market goes down, people lower the numbers. Market goes up, people raise the numbers. But there are some pretty smart people out there. Again, these guys get paid to just do things like this. Now, what I'm hearing throughout the day, and I'm mentioning this in the room, I'm mentioning this in my email alerts, etc., the whisper number, the whisper job number is moving up, not down. They started on, this is Thursday, they started Wednesday, and are now moving the number up. I'm starting to hear numbers in excess of 75, even as high as 100. Okay, what we were talking about, as the number goes higher, we're starting to hear higher numbers. In other words, people are feeling pretty comfortable. So what this is telling us is that the risk is not to the downside. The risk is to the upside. In other words, money is going to be made on the upside. The surprises are going to be upside. Everyone's looking for a down number, so if the number is bad, no one really cares. But if the number is good, they're going to start caring. So the whisper number is moving up, not down. A good number could keep the market higher into earnings. Now remember, I'm writing these comments here. The chart is going out at 12 o'clock, 2 o'clock, 3:45, and 4:10. Okay, so now again, another hedge. We get up. Okay, now we're starting to make lower highs, lower lows. Okay, so we're still hedging. See, we're starting to hedge. But look at this, guys. We are not even at a 40 of the day. Look at from here to here. This isn't even a 40% pullback. 38.2. And we're oversold. We're as oversold as we were at the bottom of the day. So we obviously want to hedge. Oversold, we're going to hedge. This trade here, guys, is another $500-600 trade. Gee, if we're buying 85-cent and 68-cent options, gee, just two of these, that's $1,000. That pays for 20 options. You can see how attractive this is. And look, we hit another low. So we start buying at 85, at 70, at 55. Okay, we're starting to average down. Now here's what's starting to come out. Okay, everybody's starting to call in. We're jammed. We're high. Okay, everybody's starting to call in. We're now along 3 tranches. What am I going to do with the puts overnight? Well, I'm holding. I'm writing on the chart. Holding puts overnight. Remember the hedge there too. Okay, this is the key. As long as we have options, we can hedge. That's the key. We can hedge. All right, that's what's so exciting about this. So anyway, we come down, we hedge, go up, we hedge, and then we blow the whole thing as we're getting toward the end of the day here. We're starting to get into the end of the day, so we want to start blowing some of these things out. We're going to stop. We're going to stop hedging, just concentrate. Now, if I add all of this up, all these hedges, guys, remember, I own, let's make it easy, 5, 15, okay, 35, and here I buy some more, again, 15 cents lower. I buy some more. Okay, I'm now long 40. I'm long probably 50, 60, 70 options. Okay, average price is probably somewhere under 55 cents because I'm buying a lot more as it gets cheaper. And remember, I'm sending alerts out to hold it overnight. You'll see this when I probably do a webinar on some of these subjects. I'll probably show this one because it's a good one. I'll show we're holding this stuff overnight. Look at this, and we're oversold. Look at it, guys. We're oversold, and we're nowhere near a 40 of the day. That's a pretty fantastic indicator. And we're getting jammed. We're getting sold at the high. Now, what we're trying to do in here, okay, is the last tranche. Remember to hedge overnight. Now, this is very important. The reason we're keeping the hedges because we want to hedge overnight on weakness. Now, the market is closing right at the high, 1160. Okay, we're long the 1115, the 115 puts, the market closes at 1160 on the S&P, the big contract, and we're the mini, the 10% contract. We're long the puts at 115. Okay, now I'm going to jump to the overnight session because we want to buy any weakness. We want to buy any weakness down in here. Now, there's a lot of stuff going on overseas. There's a lot of stuff going on in Asia. So any weakness, we now have the puts. We're sold. We have no long S&P. We're not carrying anything overnight. That's the key. I want to make sure. We do not carry any because the margins become very steep. So we're out. We're selling everything. These trades, by the way, if you just add up, and I can leave this on the chart. You'll see it on the video. You can do it yourself. This is somewhere between $3,000 and $6,000 per hedge. So if you're laying out on average about, 50 cents, 100 options, $5,000, you've made between $3,000 and $6,000 depending on exactly how many hedges you do, 2, 3, 4. So you could make as little as $3,000 per S&P. Okay, so say you're doing 2, that's $6,000. If you're doing 4, you're talking about $24,000. And you're laying out about $5,000 for 100 hedges. I mean, you're already paid for them, and you're now going into the next day with puts. Now I'm going to jump quickly to the overnight chart. Okay, here's the overnight chart. We're now trading at 10.7. Okay, you can see the market is trading roughly right where it closed, 10.58, nothing special, nothing special. Now the market's coming down. Here it is, 5 a.m. New York time, 7:30 New York time. Here it is, 7:30. We're looking now, look at this, we're 11.52. Okay, we're 11.52, and we're long the 11.15 puts. So we have no risk. If we go long 3 or 4 S&Ps, we're at the money. Let's just for simplicity's sake, just make it 4. Okay, we're at the money. The market drops. Okay? And remember I wrote on the chart earlier that strong support 46.8. So we're at 52. We're now buying the S&Ps against our puts. Okay? We have about 6 points of risk. So you figure $300, about $1,200. But our 10 options would go up at least a point, or whatever your multiples of 10. I'm just talking multiples of 10. Okay, if the market goes down, we're going to pick up a point. So we're going to make $1,000 on 10. We're going to lose 600, give or take, on the S&Ps, or basically break even. Let's just make the case here. Break even on the downside. Look what happens. The number comes out. The whisper number was right. It was 103,000. This is 20 points, guys. In 5 minutes, 20 points. I send an alert, okay, to sell. Sell everything out, and now we're going to step up into the next level of options. So I just want to show you, this is here, 54, and where did we stop? 73.75. What did I write on the chart here? There is much larger resistance between 11.75 and 9. This was the first case, 11.75. We go right up to the first level of resistance. We get 20 points on the S&P. You're long 100. So if you had 40 S&Ps making 20 points, guys, that's $40,000. I mean, you have a $5,000 investment. I mean, if you did 2, you made $20,000. This is what the game is all about. This is the greatest game in the world. There's no way in God's creation you're going to be long 40 S&Ps before a number comes out, or 20 S&Ps, unless you have the puts. You got a $5,000 investment. You have very little risk. The worst thing that happens if I'm wrong, okay, you break even down, you walk away from the trade if the number is nothing there, or you trade it again the rest of the day, the following day. You still have your puts. Okay, so you didn't make any money on that trade. Meanwhile, they're all paid for because of this 1, 2, 3, 4, 5, 6, 7 hedges. You paid, and you can do the math. I mean, this is a 15-point range right in here. Look at all these 7 hedges time, 10 points each one, 500 a contract. You can see what the kind of money you can make and what the oscillator even helps you. Now we're going to move forward into the new day, because now we have a new day. We want to be long a different level of puts. Okay? Because the market is now higher. The market's trading around 1170, give or take. So we have to be long a different level of puts, the 17s. So look what happens now. We're coming into the day. Oops, I jumped too far ahead. And we'll correct that. Okay, so here we are. We're looking at the 117s under 50 cents. Okay, the market's rallying. We're retesting the high. We just make a high. We go 27% higher. That's one of the magic formulas in New Era Trader. Okay, that gives you a retest failure. Once you start taking out these numbers, these 127 numbers, we start changing dynamics. It could become a trend update, no longer a trading range. Right now, we're looking for a trading range. The ADs are flat. The market yesterday, the ADs were much stronger. Here we are at higher highs, and the ADs, the advanced decline line, is totally flat. What's that telling me? And I'm overbought. I'm not jammed. I'm overbought. That tells me it confirms the trading range. So here we are looking at puts. 42 cents, throwaway trade. Okay, now, what we did with the other puts, I think I got out at 15, 20 cents. So I ended up losing about 40 cents, about $4,000. You just made $80,000 on that trade. You made 40 times, you're at the money, let's see. You made another 24, you made probably $80,000, you lost $4,000. $80,000 on the hedges if you did 4. If you did 2, you made $40,000, you lost $4,000 on the hedges. And you can look at the math when you do it yourself. Okay, now here's what happens. Apple and the techs are down 20 points. The market is up, but the techs are down. There's a negative blog on Apple. Don't ask me why. I mean, I'm aware of Apple because the market goes up. Apple, chances are, is going to go up. And when Apple's not going up and the techs are down 20, that encourages me to be much bigger buyer of the puts. Much bigger buyer. Now here, marginal high. The market goes basically slightly higher. Here, buy the rumor, sell the news. That's what we were doing. Everything we do, we're trying to anticipate the news. Okay, so we were buying the rumor that the number was going to be better. We set it up so it's very, very difficult to lose money. And yet if there is a surprise, we can ton money. But again, no one's going to be long 40 S&P. No one's going to be long 20 S&Ps overnight in front of a number like that. But we have the protection. Here, dollar and bonds getting sold. Gold and oil up small. Germany and France fight about the bank bailout. This is still going on stuff. Okay, now here, see, game, good support, 1146.8. So we said our risk wasn't that big, all right? So meanwhile, we're averaging, we're buying some at 44, 42. Okay, we never get a chance to buy them anymore because the market just starts going down the page. Now, here's a hedge, here's a hedge, here's a hedge. But as we're getting into that support area, you notice there's hedge, hedge, hedge. We're hedging. But as we come down into this area, there's alerts going out that we're looking to cover the puts and possibly buy calls. All right, so anyway, it's fairly straightforward. The puts start hitting 180. We're starting to scale out into more weakness. They hit 193. And basically you can see that the market is now, we're getting crossovers from jammed, crossovers with divergence. Okay, here's your crossover with divergence. We're now ready to go up. So basically we're gone. So what happened here is we started buying the puts, let's say at 45, 46, under 50. They go to 42. We're long size because of the Apple and the techs getting killed. It just reinforces the trend down, the short-term trend down. You know, the news popped it artificially. Okay, now we're looking at a situation where we're looking to get out of the puts into that support area. And the support area goes a little lower. But look at this. This is almost 5 times your money, 42 to $1.93. Again, a great trade. But what I'm showing you is when you start hedging, forget you know, the option going from 42 to 93. Look at these hedges. These are all multiple $100 hedges. These are multiple $100 returns for every option. Every 42 cents, every 50-cent option you own, you're making hundreds of dollars. And by the time it gets down there, not only have you paid for them 3 or 4 times over, you end up making 4 or 5 times your money on the option. So this is one of the really, really great ways to make a living in a very, very difficult market. Again, thank you all. And until the next time, have a great time. Thank you all.